Roy, thanks for coming on this week.
Thank you, James. Always a pleasure to be with you.
Of course, we're going to get to discussing the current state of physical bullion markets, the current supply and demand forces, product premiums, etc. But just to begin, I'd like to give you the opportunity to introduce yourself, give listeners out there some insight as to, your career in the precious metals markets and just a bit of background on who you are.
Well, by doing so, I'm going to let everybody know how old I am, which is not something I seem to be very fond of doing lately, but I'll give it a go. Thank you.
Mm-hmm.
I've been in the market since 1980. My career began in New York, working on what is now referred to as the old commodities trading floor in Four World Trade Center, where I was a clerk for a company dealing in gold futures. I did that for a couple of years and then spent much of the next 3 decades working outside of the futures industry, being a trader and a market maker in physical precious metals, mostly coins and bars, which is what I currently still do as president of Manfred Tordella and Brooks.
So I guess moving on to the big question of the moment. Obviously, last week we had a huge downward force in the spot prices for gold and silver and other precious metals. Obviously, with silver dipping below $15 an ounce, I think there was a lot of bargain buyers out there, and I'm sure you saw huge demand just as we did last week. So I just wanted to touch base with you on what you saw and what you're seeing right now, and as far as as far as supply and demand, et cetera.
As we have seen, for much of calendar year 2018, our business, our collective business, your business, and MTV's business, and I trust for just about everybody else in our corner of the precious metals industry, we've seen increases in our trading activity when gold prices and silver prices have moved lower. Rallies, for the most part, have not been sustained, and most astute buyers are on the sidelines waiting for the market to move lower and reach a price point where they're comfortable investing, or for the first time, or perhaps dollar cost averaging, as they build a larger portfolio of investments. In our case, there has clearly been a very big surge in demand beginning a couple of months ago when gold headed down towards 1,300. It brought about a very significant bit of buying, and it appears as though every $50 down, there is again a significant increase in demand. Certainly the biggest jump in demand and the greatest increase in trading activity in 2018 has occurred just over the course of the last couple of weeks, with silver breaking below $15 and gold breaking below 1,200. And this has clearly been met by a dramatic increase in demands from all facets of the market, from your largest institutional players who are participating in the physical market, to first-time retail-type buyers who are now looking at the entry point for gold and silver and saying, this is a price that I'm interested in getting into the market. Mm-hmm. So we've seen a broad-based increase in our entire customer base who have recently begun buying gold and silver again.
Right. So ever since I've been in this industry, we started doing business together in the summer of 2008. So it's been just over a decade now, roughly about a decade that we've worked together in this industry, and I've known you personally. And throughout that last 10 years, I've never recalled a time where premiums have been this thin and premium volatility has been this flat pretty much since late 2015, early 2016, when we visited spot prices around this price points that we're at now. I mean, it's basically been kind of calm until obviously recently with this drop. In between that time, there's been a huge amount of secondary market products that have come back. There's been some weak hands that have obviously sold back a lot of their gold. Some have sold back silver, and that has helped to compress the premiums, obviously. What's going on the secondary market? Is there much inventory left that you know of, or is the secondary market inventory starting to be sold away? Is it starting to basically become non-existent as perhaps I'm thinking it may become?
Yeah, well, your observation in summary is spot on. Much of perhaps the greatest amount of sellbacks in the physical market that I've ever seen in my career took place in the March, April, May, or somewhere in that 3-month period, where gold eagles were actually trading at our level, at the primary market making level, as I refer to it.
Right.
Coins were trading at virtually no premium. And there may have been a couple of days in there where MTB was buying coins back below spot.
Right.
Had you asked me a couple of months earlier, and perhaps throughout much of our career, and certainly during the 10 years that we've known each other, would I have ever predicted or foreseen a day or a period where premiums would collapse like that, with gold eagles leading the charge down? I would have said no.
Yeah.
But certainly this period during this year, it found several investors, well, certainly more than several. It found a whole large group of investors who had clearly purchased metal at previous times, and perhaps in some cases at levels many hundreds of dollars higher than gold was currently trading at, either side of the end of Q1 2018. And these investors decided at that point in time they were going to adjust their asset allocations and exit the physical precious metals market.
Mm-hmm.
Unfortunately for them, those investments did not prove to be, good investments.
Mm-hmm.
My longer term belief is those that were astute enough to be buying metal over the last couple of months will reap the benefits. As I firmly believe, gold still has a very important place in everyone's portfolio, and will pay dividends as gold moves higher in the future, as circumstances which we will probably talk about in this conversation begin to change the investment portfolios of many for the times that are likely to change ahead.
Mm-hmm.
But to specifically answer your question, this most recent drop in gold specifically has taken most of the secondary market metal off the market.
Mm-hmm.
Gold eagle premiums, while not quite trading at the mint cost of 3% in the secondary market, gold eagles are now trading well above 2%, and this is the highest level they've been trading at any time in 2018.
Mm-hmm.
And one of the key factors, not only for the increase in demand over the last 30 to 45 days, but the market has now reached levels where those that were looking to sell no longer appear terribly interested in doing so, which is a good sign. So the pressure of physical liquidations, at least at the moment, has been removed from the marketplace.
Mm-hmm.
And thus premiums are moving higher, despite the fact that gold and silver, platinum and palladium as well, continue to be pressured as in their outright price.
Now, you touched upon being surprised about this. I would feel the same exact way if you had asked us in 2011. Obviously, gold and silver prices had gotten ahead of themselves a little bit. But, were we going to move sideways and downward for the next 6 years? Most people, 7 years now, most people would have said not possible. Maybe 3-4 years they'll be, but this is stretched out. It's very long in the tooth now as far as the consolidation that we've had since. And just to touch back in terms of when I first started in this business, the price action, a lot of people, they're saying that, right now in the metals markets, you see a lot of downward pressure, and not just precious metals, but also base metals. A lot of them are pointing to it, feeling almost as if this is like a 2008 scenario. Obviously, 2008 was a little bit different. In the spring of 2008, we had gold and silver on a tear. Gold had gotten over $1,000 an ounce. Silver had hit it over $21 an ounce. And then we had a huge sell-off that occurred. And then throughout summer and into fall with the financial crisis, we had gold spot hit near $700 an ounce. We had silver spot get just below $9 an ounce by the end of that year. As far as you obviously were in the very center of the physical market at the moment, at least on the Western world. What was that like? Because obviously we had products that were in shortage. We had premiums that had, gapped out and exploded. We had premiums on Silver Eagles that were selling on eBay at 80% over spot. So just take us back, if you don't mind, what that experience was like for you.
Well, it was, on many levels, it was, one of several highlights, in my career. It was a unique experience to be, in the middle of, one of the most talked about periods in the bullion market, certainly since I entered the market in 1980. Trading activity was at levels most companies had never seen previously. Ticket count, daily trading volume was extraordinary. Customers, not for lack of providing great service, but customers were simply, waiting on hold to trade because there was such an incredible amount of buying going on. There weren't enough hands on board to answer every phone call, on the second ring, shall we say?
Right.
It was a very exciting period. It was also, for many, involved in the industry, it was also a very profitable period. And as I think we all know, for those of us that have been in the market, the precious metals industry for an extended period of time, yourself included, now being in the market for 10 years plus, the precious metals industry is a very cyclical industry. When business is good, it tends to be very good. And when business is not so good, it really tends to be not so good. So, for many people, myself included, the years leading up to the boom years, as we actually, still refer to them as, those previous couple of years had been very difficult, challenging years for most market participants. So, besides the euphoria of the market getting hot, it was it was certainly a breath of fresh air coming and following a period where the industry in general was going through a rather difficult phase.
And so just looking at it where we stand today, obviously, virtually every asset class outside of precious metals and basically commodities, virtually every other asset class appears to be in some sort of bubble when you get right down to valuations on a historic time frame. Do you think that if we have a pop in some of these bubbles, for instance, the equity market, if we see a large rollover, for instance, today Trump was I saw a headline. I couldn't believe it. He said, if he gets impeached, the stock market's going to roll over.
I actually saw that as well. I don't want the conversation to get too political.
Of course.
I'll keep my political views to myself, if you don't mind,
No
even during this time. I'm not sure I would agree with that singular statement, regardless of who was sitting in the big chair in Washington. I don't believe that would. I don't believe that would actually be, the correct scenario to play out if if the president, any sitting president, is going to be, impeached. And I'm not talking about how it's going to affect, every asset class. I'm just simply making reference to how it's going to affect our industry. And, while the president may have been making specific reference to the stock market, one would have to assume that gold would be certainly an insurance investment for many. If the world starts spinning very differently because of an impending impeachment.
Yeah, it's just, I guess, a question in terms of, you have obviously stock market potential rollover. You have real estate that it's, in various cities, it's much higher than it was in 2006, 7. And you have a bond market, it's obviously, the interest rates are going up. So, the question is, how much further does this go until one of these asset classes starts rolling over? And so it's just a question of, I guess, time. Obviously we've sat through 7 years of downward prices for precious metals, and, what is it that's going to snap this thing back, and what will that look like? I mean, I am of the opinion that 2008 experience was only half of what we'll end up seeing. We basically called time out. With all the QE that went on, and all the various, things that the Federal Reserve and other central banks have done since. And so the question, I suppose, is, do you think that you will see another 2008-like scenario and toward the end of maybe this decade or into the next?
The answer is yes and no. I think I think the likelihood of a financial calamity being caused by one of the great, Wall Street or international broker dealers or bank/trading companies going under, like a Lehman, like a Bear Stearns, others that were, rumored to be in deep trouble. I don't think we're going to see that again, at least, in the next cycle, in the next couple of years. What I do believe is that there is, for the first time in quite some time, there are better tailwinds blowing behind the precious metals industry and gold, silver, platinum, palladium as an asset class, than there are headwinds ahead of us. And I say that for several reasons. We have a political scenario in Washington that certainly looks like it could change dramatically very quickly. Perhaps it begins as early as the midterm elections, which are 60-odd days away, and this all of a sudden looks like it should be supportive of the gold market and gold prices. We have an international, political scene that is always, walking on eggshells. Who knows, what the next international event, geopolitical event, causes precious metals to go up. And as you made reference, we have certain asset classes which are at lofty levels that just a couple of years ago would have been almost difficult to predict, even for the most optimistic stock picker or asset class picker. One of the things that I've always observed throughout my career and throughout, all of the investing that I do for myself, just like all of your listeners and just like you, I have a diversified portfolio, and I look at some of the asset classes of which I'm participating in, and I'm looking for exit strategies because if nothing else, history has shown you that all markets are cyclical. They go up, they go down. and I'm not professing to be, the best stock picker or the best timer in the market, but it's important to recognize nothing moves up forever.
Right.
And that could be the S&P 500 in a broad sense. It could be, Amazon stock or Apple stock, as a specific subject matter. The point being, there will come a time, and I believe it's much closer than, some of your TV commentators and writers, lead you to believe it may be, that there is going to be, a rather significant rotation out of the asset classes, which right now remain in great vogue. And the rotation out of those asset classes should and will be, in my view, a very significant contributor to precious metals prices beginning a climb, which I believe will last a couple of years. So, with that being said, I wouldn't tell you that today's price of gold is going to be the low. It may go another 5% lower. It may go another 10% lower. I honestly don't know. Everybody has an opinion. But I'm firmly convinced that the upside for potential for gold and silver, platinum and palladium, perhaps to a lesser degree, well, palladium anyway, platinum, pretty much in the same view. The upside potential, in my view, at these current levels, your upside potential is significantly greater than your downside risk. And that's how I look at the market.
Right.
Not trying to time it to pick the top and pick the bottom, because nobody can do that on a consistent basis.
Right. So you're talking more of a long-term asymmetric trade where the downside risk is limited compared to the upside potential on a medium to long-term basis.
Absolutely.
Perfect.
I continue to look at investing as a long-term endeavor.
Sure.
I think there are several people, and perhaps some of your clients are part of them. They have some percentage of their portfolio that maybe they're trading with, on short, and they're looking for short-term pops in any given market. The great likelihood is, the clients that we're all catering to in our corner of the financial community are more focused on a longer-term price objective than a short-term windfall.
Yeah, I would agree with that.
Meaning your client who buys a couple of Minsealed boxes of Silver Eagles tomorrow, is unlikely to sell them back to you if the market runs up a couple of dollars. That investor is probably more likely to buy more.
Right.
And that's the different type of focus that the investors that we are doing business with, in the supply chain process, are catering to.
I appreciate you humoring us and taking us back to when you started in the business. The people who talked about the difference between the 1970s and 80 gold, silver, palladium, platinum, precious metal peaks in 1980 versus, this 21st century mania, basically, where since 2000, there's been a lot of interest in precious metals, and not just in the Western world, like in the 1980 go round. You have now Asia obviously involved, and you have Russia and other sovereign nations. So if you wouldn't mind just giving us a little bit of you've seen both kind of up hand and close. What are the biggest differences that you see?
The one thing that always pops into my mind, and one thing that I always share, when I'm telling a story or having an interview or giving a little lecture like we're doing together this afternoon, is when I got into the market, gold was considered an alternative asset class. It was shunned by Wall Street purists. It was viewed as something out there in left field that the traditional investment banks were not participating in, and certainly if they were, may have been on a proprietary level, but it wasn't something that they were offering to their clients. Jump forward, precious metals, jump forward, to the last 15 years, beginning, in 2002 to 2003, where gold was beginning to show signs of the recovery that, came a few years later. Mm-hmm. Gold is now viewed as a fully legitimized, accepted asset class by just about everybody I can think of. Even the Wall Street Journal, for all intent and purposes, has now and has for a long time accepted physical precious metals, gold ETFs, the futures industry as a legitimate asset class and a proper component of a well-diversified portfolio. Mm-hmm. When I got into the business, an active day in the market in the U.S. paled in comparison to what an active day in the market is now. Mm-hmm. I can't cite an exact figure for you, but on a 24-hour global basis, I would say, gold probably trades 500% more ounce volume. Forget about dollar volume because the market, of course, was much lower then. But I would say, ounce volume has probably increased 500%, and maybe more since I got into the business. Mm-hmm. And I think that's the key right there. That shows you that the market is now broadly accepted and participation comes from our first-time buyers who call up to buy 100 or 200 or a box of Silver Eagles, whatever the quantity may be, up to some of the largest hedge funds in the market who continue to participate and trade in the physical precious metals market. Mm-hmm. On top of which we have gold ETFs now, right, which are certainly another opportunity and vehicle for investors to participate. But just the fact that the gold ETFs trade so actively and are so heavily promoted by some of the broker-dealer clearing firms, just adds another legitimacy factor to the precious metals industry. Mm-hmm. I think that